Good day, ladies and gentlemen. It is Thursday, January 14th, the first Virtual Metal Investors Forum of 2021. I think we're all pretty glad to be out of 2020. That was a shit show from beginning to end. I'm kind of hoping that's not going to be the case in 2021, although I have to be honest, I'm definitely got my fingers crossed here because I don't think 2021 is going to be all that normal either. Let's jump right in here. I've got a pretty full block. I've got 6 presenting companies, so we're going to try to run through this fairly quickly. Famous last words, I know. And then when we get to the end of the block, there will be a Q&A session. So please, if you have questions, send them through. And I would say it for the companies or for me, the earlier the better. I am going to have a somewhat abbreviated Q&A because of the number of companies. But don't despair because I will be doing one-on-ones with all of these companies sometime in the next few days. So I can always fit questions in then. But if you want them answered today, sooner rather than later, because I expect I'm going to have more questions than I have time to deal with. So it's going to be a little bit first come, first served to some extent. So where are we at going into this strange year? Well, obviously, as you all know, it hasn't gotten any less strange. As things evolve, the 2 runoff elections in Georgia have given the Democrats in the U.S. fair control of both legislative branches. They have control of the Senate when VP Harris basically comes in and adds her vote to make it 51. But essentially, they do now have control of all 3 of the main legislative voting branches. So in theory, they can push stuff through. Most big things in the U.S., you need 60 votes in the Senate. So it's not like they can run roughshod. It's going to have to be bipartisan. The amazing thing, really, when you look at this S&P chart is with everything that's happened, the election, the run on elections, essentially a attempted coup, for lack of a better word, last week, none of this stuff phased the equity market. Really, if you look at this chart, you see a bump, you see some uncertainty with COVID ramping up in October. Things got a little bit hairier running into the election, but really right around the time of the U.S. election is when we started getting vaccine announcements, and things have essentially been straight up from there. I mean, there's been the odd down day, but they're pretty minor, and they tend to get corrected and bought back up essentially immediately. It's really quite impressive how little this market cares about anything but the massive liquidity flows going into it. So, and liquidity is really the name of the game right now when it comes to the equity markets. And I gotta say, I mean, I don't want to sound like I'm crying wolf here because I'm not really trying to, but I am definitely beginning to get a little bit nervous about the level of exuberance in the equity markets on Wall Street. And really, it's a very unusual market. I hate that phrase. It's different this time, but it kind of is different this time because a really impressive amount of the money flows into equities are actually retail this time around. There's always a lot of institutional money going in and out, but the marginal buyer has largely been retail this time around, which is quite unusual given the size of NASDAQ and the S&P. I mean, generally speaking, retail gets swamped by institutional flows, but not this time around. The retail guys really are the ones pushing the buttons. And, truth be told, for all of the sarcastic comments you see coming out of Wall Street, the retail guys are being the smart money this time. They're the ones that are really be making the bucks. They're putting out way better numbers than most of the institutions are. The scary thing about it is you can see this shift in the market to extreme fearlessness. People are getting extremely cocky. Dips have been bought up so often that nobody even gives it a thought. When anything dips right now, they just jump in with both feet. And I think a good example of these two things, the chart on the left there shows that the total market cap for negative earning tech firms, that tech firms that still really aren't putting up any profits, some of which have never put up profits in their history. That that market cap of that group just hit $1 trillion a couple of days ago. If you take a look at the chart, if you go all the way back to around the middle of the chart, you'll see here, that's the internet bubble. We've already greatly surpassed the total market cap of negative earning companies. I didn't think I'd see that again, quite honestly, but we managed to top it in the last couple of days. And I think this chart here is interesting too, because if you look at this move that came off the election and then the vaccine news, the pink trace is companies that, and this is Goldman Sachs' definition of weak balance sheet companies. That is ones that don't have a lot of debt coverage. They've got a lot of liabilities. They probably aren't making any money. And then the blue trace is strong balance sheet companies, and those are generally sort of traditional, large manufacturers, maybe large drug companies, and a couple of the tech companies, obviously like Apple, that have huge amounts of cash on the balance sheet. But essentially, the weak balance sheet companies are vastly outperforming strong balance sheet companies since November. So it's not about fundamentals. Fundamentals have got nothing to do with this. This is pure, unadulterated momentum market. And these two charts here, I mean, these are probably the best measure of the retail side of the market in the last while. The market on the left, I find really quite astounding, honestly. What that is it's U.S. its total call option volumes, and as you probably know, call options are a bullish bet on a stock, where you're betting the stock price is going to exceed the strike price of the option before the option expires. And what's been interesting and a little scary is that a very large amount of the trading volume that we've seen in call options, particularly since mid-2020 when retail really jumped in here, and especially recently, tend to be near-term, short-term, out-of-the-money options, call options, which means they're very much all or nothing bets. Your stock either gets past the strike price in 2 weeks or 3 weeks or 5 weeks, and most of them are getting bought or that short, or basically you end up with nothing. It gives you some feel for just how much exuberance there is, and this chart goes back about 15 years, and it's not even close. There's no other period in here that's even remotely like the current one when it comes to this. This is one of the things that factors into this euphoria panic model that's being generated. I think it's JP. I think it's JP that does this, Morgan. But this is also a fairly well-known chart. You see this one fairly often. And again, if you go back to the bubble right before the great financial crisis, that's really the top for 1.5, way into the euphoria level. But again, we just screamed past that in the last couple of weeks. We blew that record out of the water. And there's an old saying that's attributed to Keynes that says the market can stay irrational longer than you can stay solvent. I happen to agree with that statement. The truth of the matter is, overbought markets can stay overbought for a long time. Oversold markets can stay oversold for a long time. So the fact that things are this exuberant doesn't automatically mean we're going to hell in a handbasket. What it does probably mean, though, when it does roll over, and I don't know whether that's going to be in a week, a month, or a year, when it rolls over, it's going to be ugly. The pullback off of this type of move tends to be very nasty. Nobody should have any illusions about that. Momentum markets tend to fall off a cliff. When they end, they don't gently settle back to earth like a feather. They fall off a cliff like a brick. I mean, that's just how these kind of markets work. So, and again, I'm not yelling fire in the theater. I'm just telling you this is something you kind of want to have in the back of your mind. And if it keeps going, we get another 2 or 3 or whatever months of it just running like this. I think you want to really give some serious thought, maybe talk to your broker about things like index puts, where you're essentially buying insurance. The way an index put works is you buy it, you're paying to be protected below a certain strike price. If it doesn't drop below that strike price before that option expires, then the option expires worthless. but it's really insurance, and that's the way you should think of it. Is if you're starting to get nervous about it, you don't want to pull all your money out. Something like index puts gives you some insurance without forcing you to pull everything out and go to cash. But there is a cost to it. But it is, like I said, it's insurance. You treat it like insurance. It's just the cost of doing business. And I know everybody's crypto crazy right now, and I don't have anything against. I'm not one of these old codgers that hates Bitcoin or anything, but I also don't think anyone should have any illusions about it. It is a speculative asset. That's what it is. I know, blah blah blah. It's this, it's that. It's a great things in sliced bread. At the end of the day, when it comes to pricing, it's a spec asset. Don't make the mistake of thinking of it as anything else, because I think it too, when it pulls back, it's going to be ugly. The good news for us is everybody hates us, so we're not in that unfortunate overvalued position because everybody hates miners. So you should count yourself lucky that you're not part of the Momo crowd. We're going to be part of the next Momo crowd. That brings me to the gold market and the gold price. I've been hearing this a lot lately. Where's the love? It's certainly not in the stock prices of a lot of the stuff that we follow. There's a lot of very frustrated gold bugs out there. I mean, personally, when I look at the gold chart, I don't really think it's that ugly. I mean, it's not pretty, but I mean, come on, folks, it's 18. The stuff's 18.50 an ounce. It's not like we're getting killed here, but it has been a downtrend, a gentle one, since the end of August, and with everything else running like crazy, there have been a lot of large investors that exited. That's ultimately a good thing. You don't get a reversal in one of these trends until most of the hot money leaves, and I think most of it's probably out now. And so, the question is, what's driving this, and what's driving it right now? This first chart here, I put the U.S. dollar on the right side, and as I'm sure everybody knows, there's an inverse relationship between the gold price and the U.S. dollar. You can see how coming out of the pandemic crash, the U.S. dollar had a fairly steep drop, which of course coincided with gold's move up. In the last couple of months, there was the dollar flatline and it fell again, basically right to year end. You didn't really get a strong negative correlation. There were in fact lots of days during that period where the correlation between gold and the dollar was essentially positive. The reason for that is because really the other driver, and in my opinion, the more important driver, and I've said this for years, is essentially the level of interest rates, and specifically real interest rates, inflation-adjusted ones. The next pair of charts, same gold chart as before, 1 year. The chart on the right this time is the TNX. It's a U.S. 10-year yield on 10-year treasuries. This is a nominal yield. It's not a real yield. But for pretty much the entire year, the CPI has been running at or a little above. It's like 1.5 to 2%. So if you subtract that from the yields here, right now the real yield on the 10 years is about negative 0.9%. It's actually it actually dropped off through November and December as inflation expectations started picking up after the vaccine announcements came in, and that's the reason why you saw this move here from about 1750 to 1950. It fell off a cliff again here in the last 2 weeks, and if you look on the right side of this chart, you can see this big bump in yields. There wasn't really a move in inflation expectations, so negative interest rates got smaller. That drove some selling in the gold market. I think there's a couple of reasons why we saw that happen. One was just a reflation trade with all the vaccine, and it became evident that the Democrats were going to get control of most of the legislative levers. The implication of that is there's going to be a lot more stimulus spending. The simple thought would be, well, if that's going to happen, that means the gold price is going to go up. Ultimately, it probably does, but in the short term, it had a couple of shorter term price implications that were negative for gold. One was that bond yields went up because bond traders are saying to themselves, there's going to be a deluge of paper. If the Democrats are really going to try to push through 1.5 or 2 or 2.5 trillion in stimulus and spending, somebody's going to be issuing a hell of a lot of bonds, and we're going to have to eat that paper. and that's part of the reason why we've seen bond yields move up. And another reason for that is, again, just a reflation trade where you do get rising bond yields when you get people thinking there's going to be higher growth going out. What we haven't seen yet, and this is the other part of the picture, that in order to get the gold price we were hoping for, either those bond yields have to ease off again. I think they may here in the short run. I still think everybody's underestimating how much of a drag COVID's going to be for at least the next 2 or 3 or 4 months. I think the best indication of that was the last non-farm payroll number was a fairly large negative surprise. There was actually a decrease in payrolls. If you saw last Thursday and again this morning, the weekly unemployment claim numbers were quite a bit higher than expected. In other words, there's been another bunch of layoffs, and it's not because we're seeing formal lockdowns. And I'm not assuming Biden's going to do formal lockdowns, and in fact, I don't think he can. That's a state and municipal thing, and I don't think he wants to. But it's just that if the situation gets bad enough and there's enough floating around, people pull back, they don't go out as much, and you run into this problem we've already had before early last year with bars and restaurants and retail, those sort of jobs. And I think you also see a reflection of that. If you look at the chart on this page, what this is running back about 2.5 years. This shows you two traces. It's two separate subcomponents of the CPI index. One of them is services, which is the black trace. You can see how services, generally speaking, because that's like things like insurance, medical billing, they tend to have higher price increases in any average year. Those have actually dropped off fairly significantly between early 2020 and now. That's been a drag on inflation, and that's things like haircuts and lawyers and accountants. And interestingly, medical costs have eased significantly, which is a little strange when you think about it, but they have. On the other side of the coin is the commodities, ex-food and energy. Both of these are ex-food and energy. You can see that's actually reversed and gone from being a drag on the CPI, which it was early last year. Now it's actually by far the stronger component of it, and I think this trend's going to continue for a while. Right now, we're still in these very negative comparisons, but when we come out of February, March, you're going to start seeing these really strong comparisons next month and the month after, especially when it comes to things like energy costs. If you remember back to early last year when oil essentially went negative price-wise, when those comparisons start getting built into the CPI index, you'll probably see it come up 0.5% or so in the next couple of months. Question is whether that continues. Honestly, I don't know. I mean, I'm not as sold as a lot of people are on the inflation trade. I think inflation is going to increase, but I'm certainly not expecting it to go crazy like I know some people are. But that's a big deal. If that moves up, even say 1%, I don't think the Fed lets interest rates follow it to that extent. Although they've never said how they're going to do it, I've felt for months now that at some point we're going to see the Fed start instituting yield curve control. I assume they're going to do it with something like QE. Basically, they're just going to go into the market and buy this stuff up to bring the yields down. But I don't, in the short term, based on what they're saying, I don't see the Fed being willing to let those rates run. So we could get another increase in negative rates here, 2 or 3 months out. So I'm not concerned about the gold price. I think it'll be fine. We're going to have to get through this high volatility period. The side of the metals market that has continued to do quite well. There's 4 charts here: copper, zinc, nickel, and lead. All of the base metals have done quite well. Again, some of this is reflation trade. Some of this is supply disruption. But I think a big factor this time, and it was the same one that was a big factor last time, is China. China has really been the impact of China this time around has been quite underestimated in the metals market. But they have been very heavy buyers. So for base metals, where's the love? It's in Asia. That character is the simplified Mandarin character for love, by the way. If you ever need that or you're going on a date with someone. China was the first one, obviously, out of the COVID crash. They're pushing hard on infrastructure. and construction, but they're also pushing hard on shifting over to more electrification, cleaner power sources. I mean, everybody knows pollution is horrendous there. They're trying to get past that. They're obviously concerned. They're looking at the same forward pipeline that all of us are in the mining sector. They know it's going to get tight. They've been very aggressive buyers, especially things like copper and nickel, cobalt, that they're not big producers of. They've been buying a lot of zinc too, I think, but they've really been buying a lot of copper and nickel. They've really pushed that. And if you look at this chart here, this is sort of good news going forward. There's two lines in this chart. The yellow one is this basically the CRB index. The red one is a measure of liquidity in injections by the Bank of China. You can see back at the start of the chart here, which was coming out of the financial crisis. You know, China was really the one that pulled everybody's chestnuts out of the fire. They were the ones that did the $1 trillion infrastructure program. Not as much of this is going in infrastructure, but they're clearly concerned about getting things rebooted because the Bank of China has really been pouring money into the economy. They're also worried about their financial systems that have been doing liquidity for that reason as well. But this does tend to run ahead of the CRB. You know, the CRB's done pretty well here, but if we take this as being a good forward indicator like it was here and here and here, odds are we're going to see more increases in metal prices going forward through the rest of this year. So, I mean, that's about it. Very quick wrap up because, of course, I ran over like I always do. Basically, large stimulus is back on the table thanks to what just happened with the elections. I personally think COVID, I don't think it's going to be a huge drag, but I think COVID's probably going to keep the economy in the U.S. a little bit slower than people think, at least in the early part of the year until there's really wide vaccinations. We're going to see, I think, higher volatility in precious metals here, but I think ultimately gold and silver come out of it stronger. We're just going to have to get through this period where we're shifting to inflation and the yields are moving and inflation's moving against each other. And that's going to be driving gold prices up and down. But I think at the end of the day, it's going to be a nice upward slope. We just have to get through this period. Again, base metals have all had a big move. Don't be surprised if we see a little bit of backfilling along the way, but so far at least there's no indication that the buying out of China is going to slow down, and we should see more buying volume coming out of Europe and the U.S. as they start cranking things up again. Lots of juniors have money right now. It's not a particularly hard time to raise money. This is going to be another year of heavy exploration, another year of heavy news flow. Good discoveries, including a couple of ones in this speaking block. They are getting traction. They are getting support. Like maybe they're not moonshots, but there's definitely buyers out there for good discoveries. The assay backlog is starting to clear, but unfortunately, I think when we get later into the year, we may see that jump in again. I haven't heard anything about labs bulking up, so I'm assuming this is going to be an ongoing problem. One other problem I'll mention from conversations I've had with companies specific to the Western U.S., as things crank up here, once the snows melt in the higher elevations, there are a lot of issues with rig availability. The drillers are basically flat out contracted out, so there's going to be a lot of toing and froing to get drill rigs. And last but not least, with what I started to talk with, you know, you got to look over your shoulder occasionally. I don't see any immediate red flags, but whenever you see this level of speculative activity and momentum buying in markets like you're seeing on Wall Street and NASDAQ and Bitcoin, it never ends well. I don't know when it's going to end, but it's going to be ugly when it does. So don't take your eye off that ball.